When doing a backdoor Roth IRA strategy, is that a taxable event? I've got two examples of mistakes made during a backdoor Roth strategy. I'll set the record straight. That and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Are you doing a backdoor Roth IRA strategy? If so, it's not for everyone. And certainly if you qualify to just make a normal IRA contribution, then do that. Even though the backdoor Roth sounds fancy, only do it if necessary and if it makes sense in your financial life. But if it does, wow, fantastic strategy. Take advantage of it. What's the whole purpose for this? Okay, and it came about through a few different tax laws and then still a loophole that's left open that they haven't closed, and so there you go. But essentially, if you have earned income, paycheck money, then you are eligible to contribute to a tax-sheltered retirement plan like an IRA or a Roth IRA. But the unique thing about the Roth IRA is if you have too much money, or too much income, I should say, but not just paycheck money, your total modified adjusted gross income. So all of your income before your standard deduction. If that gets too high, you're not allowed to do a Roth IRA contribution. So right now for tax year 2025, for married filing jointly, if that modified adjusted gross income is above $246,000, can't do a Roth contribution. For single filers, if it's above $126,000, can't do a Roth. Does that mean if your income's above those levels, you can't contribute to an IRA? No, you can still contribute to an IRA. As long as you have earned income, paycheck money, anyone can contribute to an IRA. The question is, do you get a tax deduction for doing so? And again, if you make above those same limits, the same limits as the Roth, and actually different ones, but let's just hit those, and you have a retirement plan at work that you're participating in, no, you can't deduct it, but you can still make a contribution, an after-tax contribution to an IRA. Once that after-tax money is in the IRA, can you then move it to the Roth, do a Roth conversion with that after-tax money? You absolutely can, and that is how you do a backdoor Roth. So I had this come up twice recently with new clients where we've had to amend their tax return because they came in and said, yeah, we've been doing backdoor Roths, blah, blah, blah. And when our certified financial planners were helping them in reviewing the previous tax returns, they noticed that they paid tax on that Roth conversion, on the backdoor Roth IRA strategy, the Roth conversion. Well, wait a second. That can't be right. And in each of these instances, it wasn't right. Is doing a backdoor Roth IRA taxable? If you do it right, it shouldn't be, okay? And I'll tell you the one example when it is, but it shouldn't be. If you are making a contribution to an IRA, and it's the only IRA that you don't have any other IRAs, you don't have a SEP IRA, a simple IRA, or any other traditional IRAs, and you are contributing to it, but in an after-tax way, you don't get a tax deduction. Then when you convert that money over to the Roth IRA, it's not a taxable event because you never deducted your contribution to the IRA in the first place. And therefore, in both of these instances, these individuals were sort of doing their own homework on backdoor Roths. They weren't working with a certified financial planner, and certainly their tax preparer was not collaborating with them on this strategy. And so the tax preparer got the tax form that said, yep, money was converted from an IRA to a Roth. They had no idea if they had previously gotten a deduction on that IRA contribution, and voila, it was taxable on their return. And the client was none the wiser, had no idea simply because of how complicated tax returns are. And you might say, that couldn't happen, right? It actually, it happens frequently enough that we just saw the instance come up twice with two different brand new clients. When your certified financial planner or the strategist is not collaborating with your tax professional, certainly this day and age where tax forms 5498, sorry for the confusion, the jargon there, I just did a video on that. When those aren't being created or sent out, it's very, very complicated to know, well, does the right hand know what the left is doing? And when they don't, very possible for you to pay tax on some income or tax on some dollars that you shouldn't have to pay tax on. In each of these situations, it was a few $1,000s that when we amend their tax returns, they're going to get back. It's also possible for those that self-prepare that your tax software doesn't ask you the right questions to prompt you to say, wait a second, on this Roth conversion, did you ever deduct these contributions? So the tax software may have not helped you much. And then finally, when you do a backdoor Roth, an after-tax IRA contribution, you should be filing something called an 8606, Form 8606. And that tracks your cost basis or your after-tax balance within your IRAs. Many people, many tax professionals too, by the way, just ignore those 8606, they don't fill them out. They say, this is not that important. And then the end result is if you go and do a Roth conversion, ends up being taxable when it shouldn't be. Thankfully, in both of these instances, they came and started doing comprehensive financial planning, and our thorough certified financial planners were double checking and were able to catch it and were amending to fix it. Now, when done right, you shouldn't have any other IRAs, a simple IRA, SEP IRA, other traditional pre-tax IRA dollars. And that's what allows the backdoor Roth strategy to really work perfectly. However, are there instances where a backdoor Roth, that Roth conversion, would become taxable? Yes. Because if you already have a traditional IRA, simple IRA, SEP IRA that has pre-tax money in it, when you then make an after-tax contribution to the IRA and you then go to convert, you can't just convert the after-tax portion, your basis. When you make the contribution, you then do a conversion later, and that conversion, or even the next day, that conversion is pro rata, it's proportionate to how much pre-tax and how much after-tax money is in there. So if you've got $150,000 of pre-tax money inside your IRA and you make a contribution of $7,000 after tax, then and then you do a Roth conversion of that $7,000, only 7 divided by 150, only a small portion, is going to be, it's going to be after tax. The rest of it will be taxable. Even if you say, and we get this question all the time, I've got my pre-tax account, my pre-tax traditional IRA over at a different company. I'll set up a new IRA at a different company, and that's the one I'll contribute after tax, and then I'll just do the Roth conversion at this other company. No. That's the IRA aggregation rules from the IRS. They look at all IRAs, no matter where they're held, and look at all of your pre-tax, all of your after-tax basis in proportion to your pre-tax contributions as well. So in that instance, the backdoor Roth can be taxable. Would it make sense to ever do that? Possibly, but you got to work with your certified financial planner, and you don't want to do that by accident. So work with your certified financial planner, avoid this mistake, capture opportunities, and do that backdoor Roth successfully if it's a prudent strategy and right one for you. Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well. Or give us a call, 574-247-5898. All right, there you have it. Go on and take your next wise step in your financial life.